ARM has put out a new report that looks at the second half of 2025. The fact that they put somebody running on there it touched my heart. This is, you guys, yes, I'm biased to this report. Charged through the TRO, is stability finally within reach? Callista Chileke joins us, Consumer Goods Analyst with ARM. Good morning to you.
Hi, Iris.
Great report. You touched everything. Global, we brought it to Nigeria. For the sake of time, we're just going to look at Nigeria, but I do want to start with oil prices. I think this morning, 68 for Brent, I think about 66 for West Texas Intermediate. How are you forecasting your report? I think 62 as a base case. How are you seeing oil prices moving this year? Talk to us about that.
So let me just give you a backstory to see, how oil prices performed in H1.
Yeah.
So what we saw in H1 was very dynamic. Oil prices, going up and then moving down again. So it started H1 is around, $83 per barrel.
That's right.
And that was, basically just, investors, sentiment and whatnot. But then what we saw moving into H1, later on during the year, what we saw was that there were concerns over, President Trump coming into power again. I know about his, he has stated that he wants to increase, crude oil production.
That's right.
And we're also seeing OPEC, unwinding their production cuts, and then also, increasing supply. So that, translated to lower oil prices in H1, as well as, of course, the global tariffs, which, changed.
Every day a new tariff.
Yes, which changed everything. So considering this, that was what happened in H1. So moving into H2, we've considered all these factors and we're adding to the mix, weaker industrial activity globally, as well as, transition to cleaner energy, electric vehicles as well are coming into play, and, OPEC plus increasing supply in order to retain their market share. So all that, oil prices should, stabilize around, 62, dollars per barrel on the back of, higher supply over demand.
Thank you. And yeah, we have your forecast, your base, bull, and bear case, 62, 67, and 50 at the absolute best. So what does this mean for economic growth for Nigeria with respect to, if we translate that into where things are for us and how that, what that does? 'Cause I think you guys have 4.3% GDP growth forecast for Nigeria. 4.13, thank you. So yeah, how does the oil thing, factor into that with what you're looking at?
So our forecast for 4.13 majorly stems from increased growth particularly in the services sector, right? Services sector and particularly the ICT sector, because of the 50% tariff hike, telecommunications hike that we are going to come into effect for the rest of this year, as well as the industrial sector as well. Stable FX environment and interest rate environment should bode well for the industrial sector. And when you look at the agricultural sector as well, but that sector still has some structural issues, climate and as well, all that. So when you come to the oil sector is still underperforming. There's still some legacy structural issues, pipeline vandalism and whatnot that are still, hindering growth within the oil sector. Yeah. When you look at the average production in first half of 2025, about 1.47 million barrels per day, not even up to 1.5. Right. So you can see how those issues have, impacted growth within the sector. So oil prices coming down potentially in H2 2025. How could that impact? For one, you could see lower oil sector contribution, particularly in terms of nominal GDP. Contribution to nominal GDP, because nominal GDP is the one that accounts for, price changes as opposed to, real GDP. And then, of course, Nigeria is very, dependent now on, oil sector, on oil receipts and oil prices. So that will flow into government expenditure and net exports, which are big components of our GDP. So.
Thank you. Nice, comprehensive. Now, look, we are all still waiting for the Bureau of Statistics to release the Q1 GDP figures and the whole rebasing. Don't know what's taking so long, but, in fact, does that distort your outlook with respect to how things could play out for economic growth? And
for one, our outlook doesn't take into account the rebasing. So the 4.13% is without the rebasing. So the MBS has come out and say, they're going to carry out a rebasing exercise, and they're going to account for an informal sector that has gone for long unaccounted for and unmeasured. I know how large Nigeria's informal sector is. They are also incorporating economies like digital economy, PFAs, modular refineries, and when that is brought into play, we will see, an expansion in, GDP figures. For example, the modular refineries that are going to be captured now. We saw oil refining segment or sector, come out of contractionary zone for the first time in a very long time in Q4 2024. So when modular refineries are now even brought into, are now accounted for, we'll see an expansion in those numbers. So you can, just to give you an idea of how, how the increase or the rebasing exercise is going to increase or impact GDP figures. There's
a tweet from Jostein Haig. He's talking about how emerging markets cannot bypass manufacturing, which is industrialization. It shouldn't depend too much on services, because you got a nice chart there on your report looking at GDP breakdown for Nigeria, some of contributions. But yeah, the idea that developing countries can skip industrialization and instead develop based on services is fundamentally misguided, except for very small countries. Every country that has transformed its economy from low to high income has done so through industrialization. So what you think we got to focus on that here? Yeah, there's your chart. I love this chart. I really like it because it's services.
So
you
can see it.
Yeah, so we're highly dependent on services. So what do you think? You think we got to focus on the industrialization aspect? Or?
Well, we have to, put in effort into our industries.
Yeah.
Now, a very depressing figure that I saw on the GDP data was the coal mining sector contracted by 121% in Q4 2024. Now, take, for example, again, the oil refining sector, being in contraction zone all this while.
Yeah.
And just because of the operationality of the Dangote refinery, it's, recorded a growth rate of about 9% in Q4 2024. Now, imagine if all our local refineries were, functional.
Optimal,
Now, all those
it would
have been higher, and would not have faced all those contractionary, periods that we saw for the oil refining sector. So, of course, we need to ramp up our our manufacturing activities. There are legacy structural issues. There are, poor infrastructure, lack of proper funding that are, plaguing these industries, and it's something that, as a country, we need to,
accelerate. All right. Also, I'll shout out the MBS. I mean, I know they've delayed Q1 GDP, but they have done the rebasing for inflation and those, So for your inflation outlook, and I know you've got your forecasts, how much of the deceleration that we've seen in inflation would you attribute to the rebasing? Should we give it all to the rebasing or other factors?
There are a lot of factors that. So just that before the rebasing, there's what we saw in the first half of the year was a much more stable FX environment. Everybody can testify to that, right?
Of course, yeah.
And they also saw fuel price reductions as well. Dangote refinery reducing prices incessantly in H1 2025.
Yeah.
When you compare what fuel prices now to what it was last year, there's a significant improvement. Now, the rebasing, of course, is inflation. The inflation figure can be, the deceleration in inflation figure can be, attributed to the rebasing in the sense that they reduce the weighting of, key items in the basket. Yes. So, for example, food has been reduced from about 50-something% to about 40%. So you can see, and food is a major player or major item in the basket, right?
Woman must eat as well. Yeah.
So that is a major reason or factor that can account for the lower inflation figures that we are seeing currently. Also, there's something that we call higher base effect. So when you look at how inflation figures were in 2024 and you compare them to where they are right now, and you do the year-on-year comparison. So if you take, for example, February 2025 compared to February 2024, you will see that year-on-year inflation is actually decelerating because of the high or very high inflation figures that we had in
that period. So take us through your bull case, your base bull and bear, which we'll put up on the screen, because I know you anchored them to the exchange rate, right? So how are you seeing things?
So we put a lot of factors into our forecast. And for one, our base case, which we put at 24.28%, is anchored on the fact that exchange rates would stabilize around 1,535 to 1,565, because we're seeing a lot of effort by the CBN to, improve FX inflows. There's some system they've designed to increase diaspora remittance in the sense of, so I think it's National BVN, and that is encouraging, people from diaspora to, pull in funds here. And the relatively higher interest rate environment when you compare it to global economies. Now, global economies are tending towards rate cuts somewhat. And right now in Nigeria, our real rate of return, that's the difference between our inflation and our interest rate, is positive compared to where it was last year. And that is a major incentive for FPIs to pull in their funds into any country like Nigeria. So we think that we'll see increased or sustained inflows of FPIs into the Nigerian economy, and that could help to stabilize the exchange rate. And H2 is typically what we call harvest season, because July, August, are harvest season, and that should help to increase food supply as well as just taper food prices, sustainably. And then also lower crude oil prices that we're projecting would translate to lower fuel and transport costs. So all that just, culminates to our forecast.
Great. Okay. What does that mean for the consumer goods sector, which is another sector that you cover? Because I think you had a chart with the as far as the sectors on the NGX. Consumer goods, they've ripped this year, like 50-something%. So what does that? I mean, I guess it's good for them if inflation is decelerating, right?
Yeah. So for one, a lot of investors have prices in already. Since when their Q1 results came in, we saw a lot of them record profits. A lot of them recorded no FX losses or cleared their FX losses. And that was a very good signal for investors. And that was why we saw, or why we've been seeing, because the rally is great. So that's why we're seeing the rally in the consumer goods space. And we think it's going to be sustained because of our macroeconomic stability is almost our reach, right? We're almost reaching stability. So we think that is, what is going to, sustain the rally in consumer goods space, given that we expect FX to be stable, interest rate is stable, inflation is decelerating or slowing. And then, we think it's great for them.
It's a lovely combination for the sector, and others too as well. Let me round off with monetary and fiscal policy, but monetary policy first. Again, coming back to the decelerating inflation, you're talking about the monetary, the MPC and so on, or rather the CBN. So great. So we've got a chart there, and this is where we talk about the the real rate of return and so on. How do you see? Can we expect a rate cut maybe from the monetary policy committee sometime this year, or how do you think they will factor inflation figures going into their next decision?
Well, the MPC has been very focused on curbing inflation and stabilizing the exchange rates. And we can say to an extent they've sort of achieved the objective, right? So the past two meetings they've had in H1, that's February and May, their body language tended towards, we're going to monitor the inflationary environment, exchange rate environment, as well as fiscal interventions, and see where it's going to lead us, basically. So what we expect in H2 is that they either hold the rate at 27.50, or they could, tend towards monetary easing and cut rates by about 50 basis points to 100 basis points. So all in all, we expect interest rates to either be between the range of 26.50 to 27.50.
Okay, so we'll see how things work out there. All right, got to talk fiscal policy. There's been a lot of talk around the debts. Although, a lot of people talk about the debt to GDP. I think it's about 52%, 52, right? If you rebase and you have a larger denominator, then your debt to GDP would actually go down. But lovely, I really love the charts in your reports here. You not only gave us external debt to total debt, you gave us domestic debt, then you actually gave us debt to GDP. Lovely. So, but no, is debt still a concern though when we think about these figures and the rising debts in Nigeria?
Well, I'll just say, debt is always a concern to everybody.
Regardless of where you are.
Debt is always a concern to everybody. But I think what we should be focused on is the debt servicing. Because that is what is really eating into our revenues. So what we've seen for the past 2 to 3 years is very high interest rates. And when the DMO was issuing, carrying out auctions and whatnot, we saw very high stop rates and all that. So now they have to repay. Those debts, and that is what is eating into government government revenue. So I think that a major concern for us would be the debt servicing.
Right.
Debt servicing. But now the DMO has released their calendar, and approximately they are going to borrow about 720 billion compared to 2 trillion that was in H1. So you can see they are trying to
massive drop
in domestic financing or domestic debt, and they are leaning more towards external.
Because the exchange rate has stabilized,
exactly.
so that allows them to...
That is the strategy. So I think a major concern for us would actually be the debt servicing, and that's something we should be more focused on, because it's eating into our revenue and affecting other parts of the economy.
I guess, so on the fixed income money market side, in terms of yields, I mean, maybe you guys expect yields to come down a bit, but there's still some opportunity there to invest in fixed income and bonds.
Yeah, of course. Yeah. So of course we expect yields to taper down.
Yeah.
For one, investors are pricing in potential rate cuts. Inflation is declining, so a lot of yields are just tapering down. So what we typically I can give our strategy.
Of course you can, please. Yeah.
So what we typically advise investors to play at the shorter end of the yield curve, shorter term instrument, maybe treasury bills between 0 to 90 days or whatnot, and then or longer tenor bond instruments. Because that way they can, for the longer tenor bond instrument, that way they can take advantage of the currently high yields there, and then can later sell when interest rates are down. They can sell and then have capital gain. So that's just the strategy that will.
That's why you call it a strategy report. Callista Chileke, consumer goods analyst, all-around analyst over at ARM. Thank you so much for a great report, taking us to really appreciate it. Very fun. Everybody should download it, read it, and apply those strategies. All right.